Good morning, everyone. You're watching a live daily market outlook for Thursday, 8th of March 2012. A lot of activities seen today in the markets as some positive tone comes again from Greece. The Greek bond swap prospect is lifted by fresh pledges as major banks and the pension funds threw their weight behind Greece's bond swap offer to private creditors yesterday, making it increasingly likely that the deal will go through and clear the way for a bailout package to avert chaotic default. A group of 30 banks and funds representing 40.8% of Greece's 2,006 billion euros of outstanding debt said they would take part in the deal, joining other Greek and foreign banks and pension funds which have already pledged to accept the offer. A senior Greek finance ministry official said the government was now optimistic that well over 75% of eligible bonds would be submitted, easily clearing the original minimum threshold it had set for the deal to proceed. In total, bank insurers and pension funds holding bonds worth around 120 billion euros have already declared they will take part. Athens, now totally reliant on international support to stay off bankruptcy, has asked its private sector creditors to accept steep losses on their Greek their Greek bond holdings as it fights to cut the public debt burden of 160% of gross domestic product. They are being asked to give up almost 3/4 of the value of their investments in return for new Greek bonds. If they do not accept the offer, Greece has threatened to pay them nothing. The European Union and the International Monetary Fund have made a successful bond swap precondition for final approval of the 130 billion euro bailout agreed last month. With just over a day to go before the offer expires, the latest commitments bring the declared total closer to the 2/3 minimum level needed for Greece to enforce losses on any holdouts, ensuring the deal goes through. So the all eyes will be today on Greece as some positive sentiment is seen in the markets overnight and this morning as euro is in a brief recovery mode of yesterday's low at 131.00. Also, a number of releases today includes two big central banks, European Central Bank and Bank of England. As expected, the ECB is expected to hold fire today to keep interest rates on hold and signal that it has played its part in fighting the Eurozone crisis after unleashing a dramatic sweep of measures that has unsettled some of the banks. President of European Central Bank Draghi is likely to put the onus on governments to fight the crisis now after the central bank pumped over 1 trillion euros into the Eurozone banking system in the last 2 months with the twin 3-year funding operations. The ECB cut rates twice late last year to record low of 1%, and the policy-making governing council, which starts meeting today at 8:00 GMT, is likely to hold the main refinancing rate at that level. The latest polls suggest that it will hold these low rates into 2013. Another central bank, Bank of England, is also expected to keep its ultra-easy policy on today's meeting as the bank looks set to keep the low rates on today's meeting to support the weak economy, with the focus shifting to whether the central bank will implement another round of gilt buying in May. This month marks the 3rd anniversary of the Bank of England's decision to cut rates to a record low and start quantitative easing. In February, the bank approved another 50 billion pounds of gilt purchases, taking quantitative easing to to a total 325 billion pounds by May. No economists polled last week forecasts any change to this or the record low 0.5% interest rate. The Britain's actually economy outlook is broadly unchanged, with the Bank of England forecasting sluggish growth for most of year 2012 and a fall in inflation to its 2% target by the end of the year from its current level of 3.6%. That does not mean that there will be a complete consensus on the nine-member Monetary Policy Committee, and the discussion is increasingly turning to whether they should be more quantitative easing in May. Euro, as I mentioned, edged higher off yesterday's low at 131, extending its gains in the Asian session and hitting levels close to 132.00 as the positive sentiment backed by hopes of Greek deal will be done today, keep the single currency supported, as well as sterling that is currently in corrective bounce towards 158.00. Also important is the U.S. labor market. Yesterday's release of ADP data that are the key indicator for the non-farm payrolls showed that the U.S. companies increased their hiring in February, and shoring up expectations that the labor market's recovery has moved into a higher gear. Separate data released yesterday showed the wages grew much more quickly at the end of last year than originally estimated, which are good news for consumers, but a potential inflation problem for the Federal Reserve. The private sector added 216,000 jobs last month, according to the ADP report, topping economists' expectations for a gain of 208,000. The ADP figures come ahead of the government's more comprehensive monthly labor market report that is due on Friday, which includes both public and private sector employment. After the economists polled poll of economists expects Friday's NFP report to show gain of 210,000 jobs in non-farm payrolls, with a gain in the private sector of 225,000 jobs, offsetting a modest decline in the government jobs. Economists often refer to the ADP report to fine-tune their expectations for the payrolls numbers, though it is not always accurate in predicting the outcome. From the markets also, just to mention that gold is still holding on to gains after finding support and edging higher during the Asian session, as fears about a messy default for Greece eased after signs it might be able to secure a crucial debt swap deal that pushed the yellow metal higher, though still holding below its initial strong resistance at $1,700 per ounce, but approaching this level in the early hours of European session as the fresh gains are pushing the gold's price higher. More of this we'll see in our technical part. Is just to mention that oil also regains strength on positive hopes of Greek problem solving today, and also on the positive U.S. jobs data. A brief look at today's calendar that is quite full. Already released Japanese indicators. Current account shows surplus of 0.12 trillion yen, much lower than expected, 0.33 trillion, and the previous month 0.78 trillion Japanese yen, while Japanese final GDP price index dipped more than expected to minus 1.8% versus 1.6% for minus 1.6%, pardon, forecast and the previous release. Unemployment rate in Australia remained actually increased to 5.2%. That was actually the consensus for today, from 5.1% of the previous month release. From Eurozone, we have early morning release of Switzerland CPI that is already out. 0.3% is the monthly inflation compared to 0.2% forecasted, and the minus 0.4% of the previous month. At 11 GMT, German industrial production is expected today to show good recovery. Today's consensus is 1.1% versus the negative release of the previous month at minus 2.9%. Central banks kick at 12 o'clock GMT with the Bank of England, the first official bank rate release. As mentioned earlier, no changes expected. 0.5% will likely stay unchanged, the official bank rate of the Bank of England, with the rate statement by MPC due to be released after the rate announcement. U.S. Challenger job cuts are due at 12:30 GMT. No forecast for today. 38.9% is the previous release, ahead of European Central Bank that is due at 12:45 GMT, and also expected to stay unchanged at 1%. That is current interest rate in a minimum bid rate of the European Central Bank. Americas start at 13:15 with the Canadian housing starts. Slightly better result is forecasted for today, 199,000 compared to 198,000 of the previous month. At 13:30 we have the ECB press conference where, as always, the ECB president will give his speech and give more hints about further steps of the European Central Bank. However, we already mentioned that no significant changes are expected, at least until 2013, as the Central Bank is likely expected to hold its ultra-low rates for now. The the Central Bank of Canada also is due to announce their overnight rate at 1400 GMT, and as well as the other two banks are expected to stay pat at this meeting. 1% is likely going to remain unchanged, 1% overnight rate, with the Bank of Canada rate statement due shortly after the rate release. So that would be all for today's calendar. Now we're going to take a look at the markets and see the latest movements of the major currencies and commodities. As we can see, the near-term action of euro sees some positive tone developing of yesterday's. Pardon, we are not looking at the correct chart. I do apologize. The near-term action, okay, we can start from hourly study on Ichimoku, where the price action broke above the cloud, and the as indicators of Ichimoku, the Tenkan Sen is now pointing higher above the blue line, giving initial signal of possible further strength. Now to the normal ordinary chart, we see the bounce of after yesterday's brief break below 131, where the support was found at 130.95. The euro maintains a near-term positive sentiment, as the studies are quite positive on the hourly time frame, keeping the upside focused. We expect the 20 days moving average currently at 131.55 to cross above 55.1, which is slightly above at 131.59, in order to confirm the current positive tone. However, the larger picture still holds a negative, more negative structure, as studies are holding below their midlines, and the current move is seen just corrective. Initial resistance was now found at 131.80 zone, where is the 4-hour 20 days exponential moving average, and they basically only break above static resistance at 132.40 high of 5th of March, as well as 55 days exponential moving average at this area. would improve the short-term negative structure as the pair remains in the downtrend, short-term downtrend of 134.85 double top, and only break above these levels would ease the current bear pressure and allow for some a stronger corrective action. Until then, most likely scenario would be the lower top below 134.20 before the bears reassert, and the loss of strong support, near-term support at 131 zone to open a way for a fresh extension lower with the 130.26 lows and 130.00 to psychological support to come in focus with possible extension down towards 129.73 key short-term support and higher low of 16th of February, and not ruled out at this point. So as mentioned, only firm break above 132.40 would avert immediate downside risk, as the studies keep the downside still favored. The similar situation is with the cable, as it is in the recovery, near-term recovery mode of recent lows at 157 zone, 156.95. Double bottom is seen here ahead of current rally. It's significant current attempt through 157.70, which is previous strong first support, the first resistance, then support, now turned again to resistance ahead of next levels on the 157.85 low of 5th of March 2012 and the 158.00 low of 28th of February, where is also the 55 days exponential moving average, and basically break above this zone 158.10 is required to confirm the bottom, temporary bottom at 156.95 and allow for some stronger recovery. 158.81 as well as 158.84, where is 200 days moving average is now. Next is our critical barrier, and only break above this level is to improve the current negative structure, as the pair failed to sustain gains, previous gains above 200 days moving average, and swiftly dropped lower, threatening now test of key support on the downside, 156.50 higher platform. On the downside, as mentioned, the failure to regain a minimum 158.10 would risk a fresh leg lower, and the possible test of our critical support at 156.50, loss of which to significantly soften the short-term structure of 152.33 low of mid-January, and the loss of 156.50 platform to open. And next levels 156.12 is 50% retracement, and 61.8 Fibonacci retracement at 155.23 would be the next targets, on downside targets on a break. The dollar yen holds a near-term positive tone after attempting to base at 80.60, where the market found support on the 6th of March and yesterday, with the current bounce heading towards our next static resistance at 81.57, a break of which is required at this point to avert downside risk and basically to refocus key upside resistance at 81.86 high of 9-month high of 2nd of March 2012. The hourly studies are positive at this point and seem supportive for further gains, as price action this morning shows the pair heading higher, and the break of 20 days moving average above 55 that currently underpins the action higher. 4-hour studies are also improving now as MACD breaks above the midline, and the momentum, although still holding below, points higher that we might see as a good support for a possible attempt at 81.57, with the 20 days exponential moving average at 81.09 underpinning the current action. A break above 81.57 and above 81.86 is required to signal a resumption of the broader uptrend of 76.00 base, the latest steep uptrend, and open levels 82 and above 82 is the psychological barrier. At 82.20 actually we have the static resistance ahead of possible further extension higher. A key near-term support is now at 80.60, and only break here would soften the tone and turn the risk towards 80.24, and the key short-term support at 80.00. A loss of this level actually would significantly weaken the structure and allow for a stronger reversal of the broader uptrend from 76.00 to 81.86. The dollar Swiss is currently in the corrective pullback of its recent high at 92.00. That was hit yesterday, brief test of our next target. The studies on hourly turned negative at this point with the 91.42 low seen so far, where the 20 days exponential moving average on 4-hour chart so far contained the dips. However, there is still room for further reversal of the current rally with the 91.00, our next strong support, static support low of 5th of March, as well as 55 days exponential moving average seen as a key support, and the reversal at above this level is seen not harming the current positive structure for a possible fresh extension of the strong short-term rally of 89.30 double bottom. Clearance of 92.00 to open next levels at 92.50. 92.50, the previous range ceiling, as well as 55 days moving average on the daily chart. Before this we have 92.30, the 90 days moving average. As well, at 91.00 we have the broken trend line, where most likely, in case of further extension, lower investors will find good bids at this level, and is likely expected likely to hold the dips for now in order to resume the current recovery of 89.30 double bottom, as daily studies are now improving, pointing higher and approaching their midlines that might signal fresh recovery. Key resistance on the short term remains at 93.00, 16th of February high, and the only break above this level would improve the broader, wider pictures outlook for possible test of levels highs at above 95.00. The yellow metal is currently in the recovery, near-term recovery mode after hitting a fresh low at 1663 on 2 days ago, with positive sentiment boosted by Greece's hopes of solving their current huge problem and avoiding default, as well as positive U.S. data. The yellow metal remains well supported in the near term. The current rally above 20 days moving average at 1691 focuses and basically break above the previous low and static resistance at 1686, and the next ones at 1694, 95. Now looking for test of 1700 as a psychological resistance ahead of our next very significant barrier at 1725, where the initial recovery attempt was capped. We need to see break above 1725, which marks also a 50% reversal of the initial down move from 1790 down to 1663, in order to improve the short-term structure and possibly focus levels, higher levels, with the 61.8 Fibonacci retracement at 1742 seen as a next on a break, and possibly to refocus 1790 as the key short-term barrier. The 4-hour studies are still in the negative field, but strongly pointing higher and emerging off their extreme levels. That might give a signal for some stronger recovery of the yellow metal, as sentiment in past 2 days greatly improved. On the daily outlook, the studies are still negative. Both indicators are below their midlines and losing traction, and basically only break above 1700, also 1704, which is a previous higher base and the previous strong support now reverted to resistance, as well as 1725 is required to improve. Otherwise, we see the risk of a renewed attempt at 200 days moving average that was briefly broken so far. The indicator is currently at 1678. The brief break yesterday was not long lasting, and we can see it for now looks like as a false break, but sustained gains above 1700, and the regain of 1725 is required to confirm this action. Otherwise, we might see fresh attack below 200 days moving average that might significantly soften the tone of the yellow metal. 1656 is 50% retracement to come next, ahead of 1625, 61.8 Fibonacci retracement of 1522 to 1790 rally. Loss of the later one would turn the focus firmly lower, and the risk test of the key support and double bottom at 1522, 1532. The crude oil is also in a near-term recovery mode after hitting a fresh low at 104.34 in early hours of U.S. session yesterday. Break above previous high at 106.53. Currently is at 106.75, heading towards our next static resistance, 107.00 and 107.30 zone, highs of 5th and 6th of March. Regain of which is required to sustain the current bounce of the levels above $104 per barrel, and open way for a stronger recovery. We need to see that the oil price has been capped at in the past weeks at 109.90 and 110.53, which was the spike high of the last week, and basically the gain of initial resistance at 107.30-40 zone is required to improve the current structure. Break above two moving averages of 20 and 55 days on 4-hour chart signals some positive action ahead as the price regains momentum, though the MACD is still holding below its midline, but off its signal line is pointing higher. That might suggest a stronger action on the price of crude oil. The daily structure is still in the positive field, but pointing lower, and the risk is seen on the loss of support, the latest low at 104.34 and 103.70, the previous range ceiling that might significantly damage the current positive tone of the crude oil in light of latest rally of 95.43 that cleared strong barriers at above $103 and then might return back to this broader range between 92.70 and $103.70 per barrel. I wish you a nice day.